Hello all, I'm Richard Saunders and I've been Regional Sales Manager for Paragon in the South East for nearly 5 years now. When I was asked to present on a specialist topic, I thought about what I've been asked about most in the last year. The clear answer was limited companies and how they can be structured. We are well known for being a buy-to-let lender that specialises in limited company mortgages, and with the tax changes that have come in over recent years, the wrapper of an SPV has become more popular. Not least because within a limited company, mortgage interest costs can still be set off as an expense. Because companies can be set up in many different ways, we're very often approached to consider a variety of scenarios. Some are more weird and wonderful than others. In this presentation, I'm going to give you an overview of the types of company ownership, shareholding and deposit injection we commonly see, and give some guidance on what's acceptable under Paragon's policy. Hopefully, by the end of the session, you'll have a slightly better understanding of how limited company structures can be used to your client's advantage. Now, our compliance guys insisted I put this page in here, so fair warning. This presentation does not constitute taxation advice, and you or your client should always consult a suitably qualified professional when making decisions about limited company setups. That said, I'll try to give you the benefit of my knowledge, which has been built up from fielding these inquiries every day. I've put the PowerPoint together in a way that it should be easy to refer to afterwards and can be used as a reference guide if needed. Before I go into some of the finer points of limited company structures, let me give you a brief summary of some of the reasons to use Paragon. We're an experienced specialist buy-to-let lender, and we've been doing buy-to-let for more than 25 years. Our expertise lies with larger portfolio landlords, larger and more complex properties, and limited company lending. And this makes up a large chunk of the mortgages that we write. We have some other USPs, such as our 5-year rental calculation, our no 6-month ownership rule, and no extra limits on new build properties. We also employ our own team of surveyors, which gives us the ability to consider complex or quirky properties. If you've ever got an unusual or out of policy property for us to consider, please get in touch. The way we underwrite our limited company loans is similar to how we underwrite a personal name mortgage. Yes, the structure needs to be correct, but with shareholding and setup needing to meet certain rules. But because the applicants, who are also the directors and shareholders, are given a personal guarantee, we underwrite as if we're lending to them personally. Taking a personal guarantee allows us to do away with any floating charges or debentures on the company, relying solely on first charge against the property. More complex setups like split shareholdings, corporate structures and intercompany loans can be considered. I'll go into a bit more detail on this in a couple of slides. We do, however, have the rule that we will not lend to a company directly to a trading company. SIC codes set out the purpose of the company, and we insist that the SPV should have these SIC codes only. We're frequently approached to ask how clients can introduce theirs or their company's funds into a transaction for a deposit. The following slides show some of the ways that clients can still use funds that come from their trading company as a deposit on the purchase of a property within an SPV. So here I'm going to show you the ways in which we see clients introduce deposit funds into a limited company. This is by no means exhaustive, and there are many variations on these methods, but these are the most common. The first diagram here shows a standard buy-to-let limited company setup, with no trading company or third-party involvement. We have 2 individuals who are 50-50 owners and joint directors of the SPV, and who buy a property within their limited company. The cash for the deposit comes from the individual savings. These funds may have originally come from the client's company, but in this instance, they've drawn the funds out into personal name before injecting into the company. A director's loan is written back to the directors from the company and is effectively an IOU for the money that is introduced. The directors can then use the loan agreement to draw down profits in the future, which can be more tax efficient than taking salary or dividends. Now, in this second scenario, we have 2 clients who own a trading company. The company's performed well over the last few years and has profits which have accumulated and not been drawn. The clients now wish to use these funds as deposit for a new property purchase, but drawing them as a dividend would incur a tax bill. The problem, as we've already established, is that Paragon, along with many other lenders, won't lend directly to a trading company. The clients instead set up a buy-to-let SPV, which is held 100% by the trading company, and use this to purchase the property. The funds from the deposit are passed through the company structure and therefore not liable for personal taxation. There are a few ways of the money moving from one company to another, one of which is an intercompany loan, which is highlighted here in the third illustration. Now this scenario is similar to the last, and we have the same two companies with the plumbing firm again holding retained profits, except that here one of the companies does not own the other. Instead, both companies have common owners and directors. One company lends a direct deposit money to the other, and an IOU is written the other way. This time, however, the agreement is between the two companies rather than the director and the company. There are a few more considerations with this method, and I advise you to speak to us to run through these, but it's still perfectly doable. In both scenario 2 and 3, we require the same individuals to be behind the companies and for the directors of the companies to be individuals, not companies. There are, of course, other ways of doing this, and your client should seek advice on which is best for them. But all three of these scenarios are all acceptable to Paragon. My colleagues and I are happy to talk you through the finer points of a particular proposition. Next, I'm going to show you how the shareholding within a buy-to-let SPV can vary within our rules. This is often used to help with IHT planning, as children can be allocated shares in the company. This can also be used with examples shown on the previous slide. So you can see there's a lot of different variable possible combinations of company structure and shareholding. To start with our policy, Paragon require all directors of the SPV we're lending to and 80% or more of the shareholding to be party to the application. This does give the directors of the company 20% shareholding that they can allocate as they wish. In this first example, Mr. and Mrs. A hold 80% between them and are joint directors. Their children are allocated 10% shareholding each and are not directors. So in this instance, we only need Mr. and Mrs. A to be party to the application, as they hold 80% of the shares in the subject company, which is enough for us. In this second example, we have a company structure with a parent trading company, similar to what we saw before. In this instance, though, Mr. and Mrs. A own 100% of the trading company, which in turn owns 80% of the buy-to-let SPV. The other 20% is held by their children. Because Mr. and Mrs. A hold 100% of the parent company, we only need Mr. and Mrs. A as applicants. The children don't need to be party to the application. If, however, one of the children held 30% of the shares or was a director, we would need to have a three-person application. Now, this really is only the tip of the iceberg, and there are far more complex arrangements that we see every day. We're happy to consider these on a case-by-case basis, so again, speak to your regional sales manager. Now, I'm not going to go through this page line by line, but here I've put together a checklist of questions that I would ask if I were presented with a limited company deal to place. These are the same questions I'm going to be asking you when you call me to discuss a company structure or deposit question on the limited company buy-to-let, and the same questions our underwriters will ask you when you submit a case. It's not exhaustive and can't cover every possible scenario, but should be a good start to help you get your head around the setup. And this should help you establish which of the scenarios in the previous slides that you're dealing with. And the last piece of Paragon policy I want to highlight is our incorporation process, which is quite unique in the marketplace. What this does is allow a client who takes out a buy-to-let mortgage with us in a personal name to move that property and mortgage into a limited company mid-product and mid-term without breaking the contract or incurring any ERCs. This can help with those clients who want to remortgage now to take advantage of current rates and possibly borrow more on a 5-year fixed rate, but who plan on incorporating their portfolio within that 5 years. In the example here, we have clients who remortgaged their portfolio to us in 2018 in personal name on a 5-year fixed rate. The tax changes now mean they're not making as much profit on their portfolio. So they seek advice and they're told to move their portfolio into an SPV, and that's the best advice for them. The clients approach us, go through the process and engage their solicitor to complete the legal transfer. The net result is they can continue with their 5-year fixed rate, but their limited company carries on the mortgage contract for them. There are some forms to complete with our customer services team, so it's not an overnight process. They also need a solicitor and will be responsible for the legal costs involved. The only fee they pay to us, though, is their deeds release fee of £90 per account. In summary, if a client is considering incorporating but wants to remortgage now, there's no need for them to work around that, and they don't have to wait or take a short-term deal to make that happen. They can take a 5-year deal with us now, get the better rental calculations that go with that, and still incorporate later on in the fixed rate period. Lastly, I've put the contact details of our regional sales managers and our head office teams. We've all had to become experts in this subject over the last couple of years, and we'll be happy to share our knowledge with you and in turn help you place cases. So if you have a case that with any complexity, please speak to your local RSM in the first instance. For anything case or processing related, the telephone team's details are here. And for queries regarding our existing cases or an incorporation process, the customer services team handle those, and the details are there as well. Thank you all for your time, and I hope you found this useful. I'm happy to take any queries offline if they're of a specific nature, but we now have an FAQ session where you have the opportunity to ask me any questions on the back of this presentation. Thank you.